And then we're going to go into the, I think we may be finishing chapter 16 handout. So we'll see. I think there's too much left in there, but I could be wrong. Okay, so let's start with the CPA exam. Well, first of all, one thing, these are in Blackboard. There's a tab called CPA exam info that has the stuff in there. You do not need to turn these in, but the CPA exam info is there. All right. Okay, CPA exam. The base salary for CPAs in Chicago is between $74,486. The upper end here is most likely going to be partners in CPA firms. I would guess, maybe not, but most of those would probably be those are the top. And getting a CPA, I think maybe we didn't talk about that. I can't. Being a CPA it's a license. So CPA is a license, and that's different than most designations. Most designations are not licenses; they're bestowed about by a professional organization. But the CPA exam is actually a license given by the state, and it's similar to a driver's license. You know, if you want to become drive a car, you got to pass the written exam, and then they take you out on a road test and see if you can drive the car. So you have an exam, and then they take you out and see if you have the experience to drive the thing. Same thing with the license at CPA. You pass the CPA exam, and you get 1 year of experience, and you are a CPA. They give you a license. And it's just like a driver's license. It's a little bit different. It obviously it allows you to do it allows you to do audits of financial statements. That's all a CPA license is, and it's actually a pretty narrow license. But anyway, the state gives it. It's a license. The state gives it, and the state's the only one that can take it away. It can be easily transferred between states. So, and this is somewhat new. I was going to say too new, maybe like in the last 10, 15 years. It used to be kind of hard to go between some states and other states, but now if you pass the CPA exam, you can have that transferred to any other state you want. So if you want to go to Arizona, you go to Arizona, and what you do is you apply, you have your credentials and all that from Illinois to Arizona, and Arizona will issue you a license in their state as a CPA. Now you can actually have more than one state where you are a licensed CPA. You can be licensed in all 50 of them if you want. The problem with that is that you got to pay $300 or whatever for the licensing thing. So, but what you can do is get a license in another state and then forfeit your license in Illinois. And if you move back to Illinois, you do it just reverse. You get the license in Illinois, and then you forfeit the Arizona one or whatever. But anyway, you can move around from state to state with it much easier than you used to do in the past. Which is a really good thing. Okay. The CPA exam used by every state is exactly the same. Standard CPA exam is made by the American Institute of Certified Public Accountants, AICPA. So there's one group that makes the CPA exam, and they also grade it, the AICPA. And every state uses it. They don't have to, but they do. To sit for the CPA exam, you'll need a bachelor's or master's degree in accounting. To pass the CPA exam, you're going to want to take a CPA review course. And just say no, the CPA exam is 4 parts. You may have already gone over this in other classes. 4 parts, you must be completed within 18-month period. I shouldn't say completed, I should say passed. Oops. Okay. Change that to passed. So you got 18 months to pass. Okay, best use the ACCT practice courses when issuing the license. Actually, there's a lot of places that are that do the CPA review. I wasn't familiar that the ACCT was doing it, but Becker is like the big one. That's one that probably half the people use is Becker. But the ACCT actually doesn't license anything. The CPA only makes the exam, and that there is a distinction. When you pass a CPA exam, the AICPA sends you a letter and says, hey, would you like to join our club? The AICPA is just a club. They have no actual authority as far as the government agency. None.
Yeah, I'm a part of their little club. So that's why I was asking.
Good.
Because I get emails at least like every other week or something like that saying about the courses that they have for the CPA review.
Okay.
So they're the ones that issue the exam. Would it make more sense to kind of go with their review?
I had no idea that they were doing that. Seems a little odd because they're the ones making it and they're supposed to be objective, but it could be. I mean, the Becker is like the one that most people go to, but there's other ones. There's Gleim and Miley, and there's a few other ones. But I'll look into that because I did not know they were doing that. But
okay. Yeah, I know Dr. K said something about Becker. He's big up about Becker. So
something like half the CPAs in the country come out of Becker. So part of that is self-fulfilling. They okay, we got all these people passing it, and then they get more people coming in. So actually, they're going to have more people passing it. But a CPA review is really important because the layout of the exam and so forth is not intuitive, and you need to get the software and that. Which, from what I understand, it duplicates what you're going to see on the exam. So you definitely need to take some kind of a review. It'll be a computerized review because the exam is computerized. But yeah, so yeah, you definitely want to take a review though. And a lot of times reviews will have some kind of a guarantee that if you do all the parts of it and you don't pass, you can take it for free or something. Okay, 2024 exam, which I imagine is what you guys are probably looking at, is going to be a big change, probably the biggest change that's ever happened to it. There are core classes, so these are the cores that everybody takes. So core 1, core 2, core 3, so accounting, audit, and tax. And audit is the one that is basically more aimed at the license because that's what the license gives you. It gives you the ability to audit financial statements, and no one else can do that. If you don't have a license, you cannot audit financial statements. Called practicing without a license. Now, so they used to have 4 tests you had to take. Now they give you a choice. So you got to take those 4, but then you got this other choice of stuff. And the first one here, business analysis and reporting, this is sort of like they say accounting, but this is actually kind of consulting stuff. A lot of it, it's business analysis is sort of like looking at their business, seeing how to improve it, that sort of thing. Information system and controls, this is sort of like the auditing. If you're going to be an auditor. And the tax is, of course, tax. And these are kind of the 3 ways that CPA firms make money. They do accounting, but also consulting. They do auditing, and then they do taxes. So there's 3 specializations. Okay, now you only get 1 license and it's all the same. So the license has not changed. It'll just be the same license. And it will not have your, whatever you specialized in down here, whichever one of these you picked, it will not have that on there. And taking one of these, whichever one you pick, it does not make you an expert in that field. It's simply trying to kind of match up your interests and what you plan on doing in a CPA firm with what you're studying. So it's still the same exact license. The license is not going to change. And it won't be on there. Now, I would think, though, if you pass it with the tax compliance and you're going into taxes, you'd probably want to tell somebody that, and you can put that on your resume, certainly. But the license is the same no matter what. And you can read kind of what they do for this. Business analysis and reporting, option 1, option 2, option 3. Okay. Technology will be tested throughout the entire thing, they say here. The exam is still going to be 4 sections, 16-hour format. They're basically a ballpark around 4 hours each. And like was said earlier, you have to pass those in what they call a rolling 18-month period. And that once you pass the first part, once you pass the first part, then you have to you have 18 months basically to pass the rest of them. So that 18 months starts after you pass the first part. You have 18 months to pass the other 3 parts. Now, if it goes past the 18 months, you lose that first one. You have to take that one over, but it starts with the next one you pick. That will start the 18 month, the next one you passed. That will start the 18 months from that one. So it's what they call a rolling 18 months. All of them have to be completed within an 18-month period, wherever that 18-month period falls. Okay. Procedures for the exam. These, I think I got these a couple of years ago. These might be out of date, the cost to it. But sitting for the exam itself is going to be about $1,000 in total if you take all 4 parts. You have to get your credentials looked at to see if you can sit for it. So generally that's a if you have an accounting degree, you can sit for the exam. I'll tell you a weird one I had a student that had he had a master's degree, and this was a few years ago. So, he had a master's degree, and I'm teaching a freshman class, the introduction class, and he's in it. And he passed the, he had a master's degree. I said, what are you doing in here? And he said that he got his first accounting class at a school that wasn't accredited. And so he was in Minnesota, and Minnesota wouldn't take even his master's degree. So he could technically teach the class, but it didn't count towards his thing. So he had to take it. So sometimes you run into weird things like that, but that was years ago. I don't think that would happen today. But anyway, it was kind of an odd thing that happened. So anyway, credentialing, you pay the money to get there. You can also have a pre-evaluation fee that if you're really not sure how, you don't know, you say, gee, I don't know if do I need 2 classes or 10? How many do I need? You can actually pay $50 and they'll look through it. You'll still have to pay the $200, but this might give, for less money, you'll figure it out quicker, what you really need. Okay, so anyway, so these are, the application fees and the different ones here. Go online, create an account. Once you are passed for it, you'll get a letter from the Illinois Board of Examiners, and you'll receive a payment coupon, you pay that, and then you get a notice to schedule for it. And you go through the prometric testing. Now, it's not a bad idea. Some people say, well, I'm going to wait until I'm going to take it before I pay all that, right? It's, it's a lot of money, and I don't want to. There is a problem with a prometric site, and that is that it's not easy sometimes to get in a slot that you want to do it. So if you want to take it, let's say in August, you may want to pay, get all the upfront stuff done in, say, February or something like that, so that you can get in there. A lot of people sign up to take the test. A lot of times they back out, but they take up that slot a lot of times. I don't know if they've cleaned that up yet or not for prometric, but anyway, if you want to take it at a certain time, if you have it planned out, okay, I'm going to take it, this time. It's not a bad idea sometimes to do it ahead of time. Get that time slot, that you plan on sitting for it, because it's going to be, if you do it a month before, you're probably not going to get it. At least that's the way it was in the past. It's kind of a irritant thing about this. It was happening a lot for a while there. Okay. This is just some, show up with identification and all that. And you get the scores back fairly quick. I'm not, this might be a little out of date, but you get them back fairly quickly. Yeah. And you can, and they have windows that they're open to take the exam. And you can take all 4 parts in any given window. The windows are basically 2.5 months, and then they're off for like 10 days or something. So you can take all 4 parts in one window. You can't take the same part twice. So if you take the, you take the auditing part, and you say, okay, I didn't do well on that, I'm going to go back and take it again. You have to wait until the next window to do it again. So there's 4 windows in a year. They're basically every 2.5, 3 months, somewhere in there. And so you get 4 chances a year to take all 4 parts, depending on what you need or want to take. You can space them out too. Any questions on it? All right, the next part I want to cover is how do you remember things? And this comes about from me teaching the CPA review, and I don't have really any. I don't want to say I'm truncated, but I didn't really have too much interest in understanding memory and retention until I started teaching the CPA exam. Started thinking about how do we. It's a huge amount of information, and so how do you remember it? And one thing about memory is that memory, your brain is programmed to forget things very quickly, sometimes so quickly you don't even know. A car drives by in the street. It's a blue car. You can see the color blue, you can see, but your brain tells you, look, forget it, you don't need to know any of that. You don't even realize that although you see the car, your brain doesn't register what it is, what color it is, anything like that. You hear it, your brain doesn't register that you're hearing anything. Because it's not important. Your brain automatically forgets, oftentimes without you even knowing it. So your brain is programmed to do that. If you're talking to somebody, there's all kinds of stuff in the background. Well, like here, like this, there's weird stuff in the background here. But your brain tells you, okay, forget about that stuff. It's not important. What's important, whatever. So your brain automatically, quickly kind of funnels out things that it doesn't need, kind of discards them. And so the question is, well, what do you do when you don't want to discard stuff? There's things you got to say for the CPA exam that you don't want it to forget. And studying for the CPA exam is a very condensed thing. Like each section, you basically jam for each section, and you got to do that in probably 6 weeks. Certainly no more than 8, but like 6 weeks is probably a good amount, maybe even shorter sometimes. And the reason is your brain is programmed to forget. And sometimes I'll have students tell me, I'm going to start studying the CPA exam a year ahead of time. You're wasting your time. There's no way you're going to remember something for a year. Your brain's going to long ago say, oh, we didn't do that. We didn't do anything with that. Forget it. So you got to really jam it into a very short, condensed time to study for the CPA exam. All right. Now, how do you do that? Well, you have to work with your brain and realize how it works, and then kind of, make adjustments to your studying. Okay. To get elements into long-term memory, you have to actively stimulate your brain. So this is the important thing. It doesn't matter how you stimulate it, but you have to stimulate it to keep it in there. This goes into synapses and the synapse plasticity. This is kind of like the paths in your brain that help you to remember stuff. And the synaptic plasticity strengthens or weakens over time in response to increases or decreases in activity. Okay, so it's all activity driven. Now, here's the weird thing. It doesn't matter what the activity is. So something related, the activity related to the specific academic objective, and we'll talk a little about that in a bit. Okay. Now, the strengthening must be done in seconds. And it's kind of funny when you talk about short-term memory and long-term memory, you think, okay, short-term memory is like a day or two. Short-term memory is literally like a few seconds at the most, 10, 15 seconds at the most. If it doesn't get in 10, 15 seconds, it just goes away. We've all had that. You read something and you go to answer something and you completely forgot it. You just read it. You read it like 5 seconds ago and you go, that's how quick short-term memory goes. It doesn't last for a day. It doesn't even get close to a day. Sometimes it doesn't even go to a second. So anyway, that's what you're dealing with the brain. So it has to be done very quickly to reinforce it, to get in long-term memory, which is more than, say, 10, 15 seconds. Anything that strengthens the synapse has the deeper understanding of the objective. So while you're looking at these objectives, whatever the objective is you're trying to keep in your memory, anything that strengthens that is understanding that objective. So any activity. And here's another wacky thing. The difficulty of the task has no bearing on brain activities. So it has no, it does, we all think about, higher learning and you gotta, you learn this really difficult stuff. That's when you're really using a lot of your brain. No, I mean, you could be doing quantum physics and using your brain, and you could be playing tic-tac-toe with your cat, and it's using the same brain activity. So it is not that you have to, it's not that this brain activity of really doing hard, difficult things. That's not activity that we're talking about. And that it's not going to help you anymore if the task is harder than if it's easier. Okay, ways to improve memory. So this is some things that you can do to kind of trick your mind into making more brain activity. Taking notes by hand, writing them out. And it has to do with this. The motor cortex and the sensory cortex area of your brain. It may sound strange, but writing takes a tremendous amount of brain power. When you're a kid, you remember how long it took you to write? You write, the letters out. It took a really long time. You hated doing it. That sort of thing. So it takes a lot of brain power to do that. You have to control these little tiny muscles in your fingers and your hands, and you have to write it out and know you're writing. So you have to kind of visualize it and write the letter S. which is difficult to do, it takes a while, and now we do it automatically, but it still takes a lot of brain power. It's still brain activity. And all those sensory muscles and motor skills and all that kind of stuff. So when you write something out, whatever you're writing it out about, is generating a bunch of activity in your brain. Way more than if I just push the letter S. I tipped the letter S, I didn't take too much, not too many motor skills involved in that. But if I write it out, the letter S, it's a lot more brain activity. So that's why writing things out is a really good way to do it. Some of the students will say, can I just write this on notebook paper? And I say, yeah, that's really the best way to do it. Okay. And I talk about this here, and I talk about it later on too, but sometimes direct reading handouts with fill in the blanks, very effective. Read notes, but reading out loud is a very good way to do it. This is another way of tricking your brain into. So you can talk about it with somebody else, which I encourage you to do. It's a good way to do it. It's not bad. You take the CPA exam to have a partner to keep you focused. We're going to meet for 2 hours every day or whatever it is. And talking about it is very good. Even if you don't have somebody, you can talk about it to yourself. It won't be crazy or anything like that. You'll just be talking. It takes a lot of brain power to talk. You don't think about it because we do it all the time, but if you have little kids, or if you ever were a little kid, it takes a long time for them to kind of learn how to talk. It's difficult to do. So it takes a lot of brain power to talk. And even if you're talking to yourself, right, it reinforces it. So there's nothing wrong with talking to yourself. You're actually generating brain activity. So if you want to talk about, whatever it is, depreciate, a straight line depreciation, whatever it is, saying it out loud is not a bad idea. It generates brain activity, and that's all. That's what you're looking for, is brain activity to be generated so you remember it. Now, discussions are very good too, because you generally have to do even more than speaking about it. You have to listen about it, and that's another way of getting more brain activity. I had a study partner when I went take the CPA exam, and I don't think we really liked each other that much. Not that we didn't hate each other like that, but we were very, and maybe it was good we weren't buddies and goofing around or something, because we both passed, and if there's somebody you're not as comfortable with, you don't want to rock the boat or anything. So we both always showed up. We both always did our studying and all that, and it's not a bad way to do it. Repetition. Repetition is another way of doing it. Say it over and over and over again. Write it out over and over and over again. Those are all things that put it into long-term memory. Your brain, when you repeat something going over and over and over again, your brain says, okay, this is important. Don't forget this, because we're saying it over and over and over again. There must be some reason for that. Don't forget it. Memory triggers. Some of these are kind of obvious. Guided reading, fill in the blank kind of stuff. Flashcards, you flashcards up and write your notes up by hand on the cards and then use those. This is the one that is probably the most interesting for me is this one. The visual cortex. I should put that on a test. What's the visual cortex? The visual cortex is, it takes a huge amount of brain power to see color. Now, you don't think about it. It isn't like you say, oh, that, rather than say black and white grayscales, it's much more difficult to go, oh, that car is orange. It's harder to see than this car that it's white or black or whatever. You don't think about those things because it's automatically done, but it takes more brain power to see colors than it does. It actually takes quite a bit of brain power to see things. A good chunk of your brain, my brain, everyone's brain is, or a human's brain is taken up with seeing color. We're one of the very few mammals that can do that. Most mammals cannot see color. Yeah, for instance, like a coyote. Coyote can't see color. Everything's black and white. Now, a coyote, maybe they're looking to catch a rabbit, right? If there's a big field, there's no way that coyote's ever going to see the rabbit. So what do? They try to smell it. They have a huge part of their brain goes to smell. And if you're a rabbit, okay, it doesn't matter what color the coyote is. You just want to get away from it. And so you have these great big ears, and a huge amount of their brain power goes to ears so that they can hear where this thing is and get away from it. So most animals don't sacrifice a huge amount of their brain for color, but we do, which is good because if you're doing something, you write it out, and then you highlight it, get out the highlighters, write it in colored pens, write it in colored markers. It might not seem like that's anything, but actually your brain, it's working your brain harder, it's getting more activity in your brain, and that is strengthening those things that are around you, that the brain activity around that subject so that you remember it longer. Have any of you ever had Dr. Knudsen? I don't know if you ever had. Look at one of his books sometime, textbook. They're completely covered in highlighter. I mean, I remember getting a book from him one time, I taught that class, here you can use my book. And the whole thing, is there like some code here? Because every single thing was there are all these different colors. And that's what he does. And he passed the CPA exam on the first go, and that's part of that is, I'm sure, because they probably use colors on all of it. And again, that puts things in. It doesn't sound like it didn't change the material, but it changes the way your brain, the activity of your brain. You want to make things hard on your brain. You want to generate a lot of activity, and that's what you're trying to do here when you try to put things in long-term memory. Okay, some things you already know about mnemonic devices. You sing a song or make a rhyme or something and use that to memorize things. Writing it down is good. Writing it down from memory is the best. So getting it into your memory and then writing it down, just writing it out. And here is one of the more odd ones. You guys may already know this, but studying before you go to sleep. Whatever you study or write before you go to sleep generally goes into long-term memory. For whatever reason, it doesn't. A lot of times it doesn't go into that 10-15 second rule. And what you can do too is, if you have to study for, you have to jam for, say, you're taking the CPA exam the next day, study for an hour, take a nap if you can for an hour, get back up, study again for an hour, take a nap. That cycling puts it into they'll put it into your long-term also. So those are some things. And again, most of those things are there just to stimulate activity in your brain. It doesn't matter how you do it. And it doesn't matter how difficult the topic is. And two, once you get used to doing it, on the CPA exam, you either know it or you memorize it. And sometimes it's just easier to memorize it than to actually learn it. It might take you. I remember when I was going through school, pensions was like the hardest thing in the world. I didn't understand them. I memorized them for the CPA exam. And I don't think they put it on. But anyway, so pensions were like this thing that I just couldn't ever, it didn't make any sense to me. And so I memorized. It was quicker for me to memorize it than it was to actually go through and learn all the ins and outs of the pension. And an ironic twist, when I worked for Navistar, we had 11,000 employees and 39,000 pensioners. So we were always looking at pensions, and that was, it was like bigger than the company. So and I remember after like one day of auditing it, I think this is so easy. How did I not get this? But when I was going through it, I just could not get it. Okay, let's go. I think that's it. Okay, let's go to, oh. Let's pull up the chapter 16. Okay. We do one or two of these. We do two of them. Okay, we'll do another one. Okay. All right. So let's go through this kind of a little review from last time. 1,200 shares of ITW were purchased for $20 a share. Oops, June 20, so this is 6. Hey. Okay, so our investment, fair value. And our cash is going down. Make 1,000. Okay. Oh, I know that's bold. I should have made this. I just inserted a couple rows here. July 30. Sold 500 shares of ITW stock for $22 a share. What's the journal entry going to be? What accounts are we going to use?
Cash would be debited and investment would be credited, and there would be a gain on the sale.
Yep. So we'll have cash. Asset going up. All right, so we sold 500 shares. $11,000. I gotta start using my calculator. I'm gonna start writing stupid stuff.
Yeah.
It's 11,000.
Yeah,
Okay.
good.
All right. So 11,000. And we had to take them off the books at what we paid for them. So this up here is what we paid for them. Oops, wrong one. It's 20. Oh, whoa. 10,000. So this is what we have to take it off at. So our investment. Value is an asset going down by 10,000. Okay, so we paid 10,000 for it, we sold it for 11,000, so yeah, we're gonna have a gain of 1,000. Gain on sale, I call it up here. Oh, realized gain on sale, okay, even better. Actually, all gains are realized if they, unless they say they're unrealized, they're realized. Yeah, you can just put gain on sale. That's fine. You don't need to put this in here. You don't put it in parentheses. But it is realizing that you've actually sold it. You actually made $1,000 in cash on this. You paid 10,000 cash. You get back 11. You made 1,000 in cash. It's realized. Okay. Receive dividends. November 9th. Okay, so we received dividends 10 cents a share of ITW stock. So this is going to be what?
It'd be cash of the 700 shares left.
Yep. Up. And I'm gonna put the stuff in here. So we have 700 shares left, sold 500 of them. We don't get dividends for those. And this is what, 10 cents. I think I'm gonna go through here and add those zeros in. $70. All right, so we're gonna get cash of 70. And this is what?
Dividend income.
Dividend income, sometimes called dividend revenue. I've seen it called both. The market price per share of ITW stock is $25 per share. Okay. Let's see how I did it up here. Okay, here we go. I'm gonna copy this. Again, this is part of my teaching you how to be just as lazy as I am. Very important skill. Okay, so let's see. We have what, 700 shares left. And we paid $20 for them. And the market value is now 25. Oops. And give me a second to correct these numbers. 17,500. Whoa, wrong one. Let's try that again. 700 by 20 is, I think, 14,000, isn't it? And the difference is 3,500. Okay, time to go back and check my numbers. But if I do put up stupid numbers, please don't hesitate to tell me. I'm not terribly proud, so you're not gonna hurt my feelings. Okay, yeah, I think that's right. Okay, so 3,500. So that's the unrealized. Oh, it's not a loss though. It is a gain. Right? Now, notice we did not sell these shares of stock. So this is an unrealized gain. Okay, so what's going to be the debit? What's going to be the credit?
The debit would be the fair market value adjustment, and then the credit would be the unrealized gain.
Fair value adjustment, and you can just call it the FVA if you want. Yeah, you'll often see that. 3,500. And unrealized gain. Okay, so this is what this would look like. Investment. Get some more room here somewhere. Oh, there's tons of room up here. What are we doing? Okay. So investment fair value securities. So this would be 14,000. The fair value adjustment to gain of 3,500, so we'll add that in. And so this would be 17,500. And if this investment, if you're going to sell it in the next year, you put it on the books as a current asset. If you're going to plan on holding on to it, and again, this is all management intentions. What does management intend to do with it? So if they say, oh no, we're going to keep that for 5 years or whatever it is, then you put it under long-term investments. Okay. All right. Now, when it comes to these fair value securities, they actually do a portfolio method for figuring out the unrealized gains and losses. So what we do is we find the total cost. Oops. So 70,000 plus 48. $18. And the market value for these are 127. 127,000, I should say. Okay, so. Do we have a gain or loss?
Gain.
Gain. So this would be. Fair value adjustment. Now, we're gonna have to pay attention to this, not now, because there's zero in that account, but in the future, we're gonna change that. So, but for right now, it's zero, so we'll just do the entire. This is gain of what, 9,000? Oops. Yeah, I'm gonna take that. Yeah, this is an asset. And it's going up. Okay. Unrealized gain of 9,000. So the moral of the story here is we do it by portfolio. We we don't go through each one and say, okay, ABC made 15,000, XYZ lost 6,000. We take it as a total portfolio. It goes in as one number. Some of these will go up, some will go down, and it'll run through the fair value adjustment. And down here, all these fair value securities will go in together. The cost will be 118. The fair value adjustment is 9. Oops. And the fair value of the securities is just what you'd think it would be. It'd be the 127,000. So you tell the reader, look, there's 127,000 sitting in fair value securities. That's what they're worth at year end. Okay, let's do this one, then we'll take a break. It's the same type of thing, same song and dance. Okay, I think this is what they are. And so we have a gain of what, 6,000? I'll tell you something funny. When I was an auditor, that I was going through the they call them short-term investments back then. And, you know, they had this, like, here, portfolio thing, and I remember they did pages of these things. It was like, they had, I don't know, 200 or whatever of them. And I had to go through and figure out, you know, and see what they had at year end and figure out if they used the right, you know, the right numbers on them. So you had to look up what the closing was on December 31st for all these different shares of stock. And it was a little bit off, but you know, I think it was like a several $1 million account, and it was off by $300 or something like that. So we didn't do anything with it, but you had to go through and check and see that all these are going in at the right price. Okay, so this would be $6,000. Unrealized gains. When you see unrealized, know that they have not sold it yet. I'll tell you something funny. When I was going through, we did the lower of cost or market. And so you wouldn't recognize gains, you only recognize if they had a loss. Okay, let's stop here and then we will go on the next page. The next page is going to talk a little bit of if we have different amounts in the account. So let's say stop here. Say be back at let's say 710. Okay, so. Now we're gonna do the same thing, but we have a little bit of a problem. And that is that there's something in the fair value adjustment account. So what happens is from one year to the next, you carry over these fair value adjustments and you have to make adjustments to the fair value adjustment because sometimes they'll show, you have to increase it or decrease it or whatever. But it depends on what was in there for last year. And you may be wondering, like, okay, so let's say I have this stock that maybe it's showing a gain, right? And but now I sell it and I actually realize that gain. So I get the cash out. So now am I counting that twice? Am I counting the gain that it made that was unrealized? And now it's a realized gain. And the answer is no, because what happens is the next year when they do that fair value adjustment, that stock's not going to be there. So it's going to decrease the unrealized gain by the realized gain. So you don't have to worry about, gee, am I counting this twice? The stock jumped up from $20 to $25, and we realized it had an unrealized gain, and then we sold it. Well, okay, now are we counting the gain twice? And the answer is no, because the next year that stock's not going to be there. That unrealized gain isn't going to be there. It's going to decrease the unrealized gain by basically the realized. That's kind of what we're looking at. Okay, so let's see how this works. Okay, so we have 45,000 as our cost. The market value is 57,000, so that is a gain of 12,000. Now, here's the thing though. We already have a 3,000 debit in the fair value adjustment account, which is a gain. So when we make our journal entry down here, what are we going to make it for? How much?
9,000.
So there's already 3,000 sitting in that fair value adjustment account. So we're going to only put in 9,000 on this because 3,000 of this gain was from the previous year, right? And one thing, depending on what's in that fair value adjustment account, you could have a gain up here and have a loss down here. If this was instead of 3,000, if this was 30,000, your gain is 12,000. You had a gain of 30,000 sitting in that, then it would have been a loss of whatever 18,000. So it is possible to have a gain and a loss depending on if the gain isn't more than what's already in there. Okay. No, wait, down here. So this would be 45,000. That's not 45,000. I was testing you guys. All right, and we have a fair value adjustment as 3,000 plus 9,000, we told it 12,000 in there. And the investment value would be just what you would think it would be, what the market value is right now, which is 57,000. Okay. Same thing here. Well, this one. Was it a loss? 5,000. The fair value adjustment has a gain sitting in it of 4,000. All right, so what are we gonna do? We went from a $4,000 gain to a loss of 5,000.
Wouldn't the adjustment be 9,000?
This would be an unrealized loss. $9,000. We lost our gain, and then we lost another 5,000 on top of it. The fair value adjustment will be negative. Okay, so these securities will have 85,000. No, they won't, about 90,000. I was lying. What a terrible thing to take, say. 90,000. Oops. How much is gonna be in the fair value adjustment account?
Only 5.
Yep.
Unless you separate it and do like previous and current.
Yeah, you could, I see what you're saying, you could do that, yeah, but I would try to put the fair value in as negative, what, 5,000, you said, yeah. And, you know, if you think about it, we really want this to show up on the books as 85,000, right, this is what it's worth. And so this is what we're gonna be having down here, and however, you know, if you put it separately, you could also come up with the same number. What's on that? So it matters what's in this fair value adjustment account. You have to look at that and see how that compares to whatever the gain or loss is, the unrealized gain or loss. I should put that as unrealized. Okay. Now, the wacky one. The equity method. The equity method is it's way different than the other ones, and it has to do with how much ownership we have of a company. And when you own a company, when you own a certain amount of a company, the normal way you think about things like dividends. I am so sorry. We got this artificial deadline that was actually yesterday, and now it's all for an assessment thing that's going to anyway, my problem. But anyway, so I'm getting like text from Beans and all this. Okay, so let's say that I have two companies, right? Company A and Company B. That's either wrong order. A and B. Okay. Now I own both of them. Now suppose company, oops, here's company A. Suppose company A gets a dividend from company B. How much wealthier am I? Oh, it was a quarter, by the way. I'm not any wealthier, right? I mean, if I own both of them, getting a dividend doesn't really matter at all. You know, if B pays A 25 cents, well, now B is worth 25 cents less and A is worth 25 cents more. That's all that happened. And so when you own a certain amount of a company, things, especially like dividends, really don't matter. You're just taking it out of one asset, putting it into another. So that's kind of the idea behind the equity method. So when we look at the equity method, how do we make money on the equity method? We generally do it through net income. 2 and 3 we're not going to get into in this class. In the advanced class we'll go into those, but we don't need it for this. Okay, so the equity method, you make money by having net income, just like your regular business. How does my how does my company A get more money? Well, company A gets more money by making income. Then you have more money in company A. Just like a regular business, you think of it as if you were running the place. Okay. And we still make money if we sell the things. We have a plus or minus for the if we sell them, but realize a gain or loss. But we make money by getting net income. Okay, on the balance sheet, how does it change? Well, on the balance sheet, it changes by our net income. Oh, we put it out whenever we paid for it. And forget about those two, forget about 3 and 4. But notice that dividends received is a negative. And you say, well, wait, why are dividends a negative? Well, dividends are a negative because it's simply taking money out of this company. Now that company is worth whatever the dividends were less, and I have more cash, but it's just simply trading one asset for another. So these are really kind of the main ways. I'll highlight the main ways, main things we got to concentrate on here. And again, it happens. This is how these things change is by net income and dividends will just simply reduce it, but also net income will increase your income. Okay, blah, 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 blah. There is something else here. Actually, it's what's missing here. What is missing here, I'm going to put in there, is that there are, oh, wait, what did I just do? Missing is how to use a computer. Okay. The equity method does not have unrealized gains or losses. It doesn't matter what the stock price is. Notice this investment account, up here, the stock price will change what you have in that account. Here's the fair value of those securities. Down here, there is no adjustment for the stock price. Whether the stock price goes up or down, it makes no difference. We don't do anything with it. So there is no unrealized gains or losses with this. And again, it's one of those things that may not be obvious, but it's what's missing. They have all this stuff, but none of them are the actual stock price. Okay. Let's go to a problem and see how it works out. Okay, so it seems like there's a lot of space here. I tried to condense them, put two on one page, and I just couldn't do it. So I went back to the old. And I apologize. I try to be more conscious of people printing these things out, but all right. So let's see. This is going to be similar to what we did before. January 1st. 40% of Franco Corporation was purchased for $56,000. Okay, so 40%. They don't tell us whether it is influential. So we're going to use this 40%, and it is between the 20 and 50. So we're going to be using the equity method for it. If they said it was non-influential, we'd be using the fair value, but they don't tell us. We see it's 40%. We don't control it. We're not in control of the company, but we are very influential, apparently, if we have 40%. Okay, so we have an investment in, say, equity. Asset going up for 56,000. And what's going to go on the other side?
Cash.
Yep. Cash is now going to go down. Asset going down. 56,000. Wrong. Wrong again. Okay, so we put this investment on the books. May 23rd. Franco Corporation pays total dividends of $1,000. So the total dividends they paid out was $1,000. How much of those do we get?
400.
Yep. So
dividend income and cash.
Actually, the cash is right, but hold off on the other side. So we're gonna get cash. Oops. I have a good calculations down here. So this is 1,000. That's 40%. Equals $400. Okay, so $400 will be cash. Now, here's where it gets wacky. We own so much of it that we're gonna take it out of our investment account. We own so much of it, it's kind of like the, it's kind of like this thing. Here's here's assets of. I'm no wealthier than I was before, because I own so much of the company, I own 40% of it, that it doesn't, if I get paid dividends, it's simply making, one asset, my cash higher, but my investment is now lower. So this is gonna be coming out of the investment account. This will be an asset going down. And again, there is no income associated with it because it's simply one asset's getting larger, the other one's getting smaller. So our investment at this point, our investment account is well, whatever, 56,000 minus 400, whatever that is, 55,600 or something. That's not me barking. It's my dogs. Okay. December 31st. Ringo Corporation reported net income of $3,000. Okay, so how much of that income are we gonna get?
$1,200.
Yep. Okay, so now this is where we pick up the income. So they made net income, so we're gonna pick that up as income. And I want to figure out. I think they usually call this equity and income. I would just call it investment income. You could also call it equity, equity investment income or something like those lines, equity and income, but just income. So $1,200. And the investment account is now worth more. They just made $1,200, so our investment account is now going to go up by $1,200. They make income the same way we make income. They make income, they grow. Loss, they shrink. Okay, looking at the journal entries for the equity method, what do you notice? In every single journal entry, there's what? What account is used in every single entry?
The equity account.
Yeah, that investment account is used in every single entry. So that's another wacky thing about this method. Every single journal entry is going to have the investment account in it. So whenever you come up with something, you know what half the journal entry is going to be. You may not know how much or which side it goes on, but you know that there's going to be the investment account is going to be in there somewhere. Okay, what is the ending balance of the investment account? Let's see here. We would have beginning balance was what, 56,000? We got dividends. And dividends will subtract from the account. It's and our investment income will add to it. So this will be the let me put a title on this. So investment account, equity, the type of account it is. And so the ending balance will be what is it, 56,800. I think it's 56,800. Yeah. So this will be our balance in that account. Should probably put a dash in here. Maybe these we have left. Oh, just one. Hey, we'll be done with this thing. I didn't expect that. Yay! Well, actually, I'm gonna, I'll talk about that next time. But yeah, we'll go ahead and do one. We'll do this last one here. I should have had more of these. This is but we'll practice more of these next week. Maybe I'll pull a couple prompts out of the book. Do next week. What are my stupid little dogs barking again? Here's the thing about my dogs. They have these little tiny dogs. They weigh like 20 pounds. You think they'd be hiding somewhere, so as not to draw attention to themselves, but instead they advertise, hey. Okay. So we bought 30%. Oh, wait. We bought 30%, and as if they don't tell us anything else, we're going to use the equity method. We're going to assume that they're influential. And again, that is not part of the real criteria, but for whatever reason, it's kind of what. Unless you're told that they're not influential, if it's between 20 and 50%, it's considered influential. Okay, May 23rd. Well, we know that one of the accounts we're going to use is that one. They paid total dividends of 400. So one of the accounts going to be investment account. What's the other one going to be?
Cash.
So we're gonna have cash going up. Let's see, the total is 4,000, we get 30% of that,
1,200.
1,200, thank you. Okay, so 1,200 and. So that must mean our next account is going to be that investment account, because it's in every single one of them. And our account is worth less. We've simply taken money out of our investment account and put it into cash. We're no better off than we were before. And down here, now this is how we make money. When the Rue company makes money. That's what we make money. Okay, so at the end of the year, we get their financial statements, and on their financial statements, it shows they have net income of 20,000, so we get 20% of it. Now, notice they didn't pay us anything. You know, this is not cash coming in. This is just, we're saying our investment is now worth, you know, 20,000 times 30%, whatever it is. 6,000.
Yeah.
So this would be, we're just saying our investment is now worth $6,000 more. So. So our company is worth more, it made some money, it made 20,000 and we get 30% of that, so we get 6,000. And this is investment income. And again, this account shows up again. It shows up every single time. And by the way, even in those ones that we didn't cover, way up here, they were. Yeah, yeah. Even if you had these, same thing. Those all run through the investment account. Again, part of my cradle to grave being lazy, I'm gonna copy this down. $60,000, dividends were 1,200. Investment income was 6,000. And notice we don't care what the stock price is at the end. You know, it has nothing to do with it. So the stock price, whatever it was when we bought it, if it went up or if it went down, it doesn't not make any difference. All right, so what is this? 64,800. I think that's right. Hey, we're done early. Woohoo! Not that I don't like being with you guys. I do. Now, is this did you guys get 64.8?
Yeah.
Okay. Good. I'm always nervous when I give it a problem. No one does that. Okay, well, that is it for this. Actually, I should probably talk a little bit about this. Held to maturity securities. You know what? I'll talk about this next time. Next time I'll go through this. It's kind of wacky. It's there was kind of a confusing part that we used to have to go through. And it's not there, excuse me, for equity securities, but it's still there for debt securities. I'm not going to get too deep into it because, you know, on the CPA exam, maybe they'll have one multiple choice question. If that, you know, it wouldn't surprise me a bit if they did test it. But we'll go through it a little bit because there's a possibility it could be out there. It could be a multiple choice question or something like that. But anyway, we'll do that next time. And so next time we'll probably do more problems, especially in the equity one, maybe a few out of the book, and then you'll do the multiple choice questions and all that, and get ready to take the exam. Okay, so let me check something really quickly. I just want to make sure that I have the drop for this. I think I do. Yeah. So chapter 16 is in there, so we can turn that in, and that's all for this week. Any questions? Okay, have a good evening.
Have a good night, Professor.
Good night.
Good night.
Night.